Hello everyone, this video works through the Gulf Coastal Design Studio's January transactions. For each transaction, we will work out the effect on the accounting equation and identify which accounts get debited and credited using the letter codes on your worksheet. Once the analysis is complete, we will add up all columns and prove that the accounting equation is in balance, that assets equal liabilities plus stockholders' equity. Journalizing and posting to the ledger will be a separate video. Today, we focus on the analysis. The chart of account listing to be used runs from cash to utility expense, or letters A through M. Keep this visible. We'll use these letters instead of writing full account names. Remember your dealer acronym as you determine debits and credits. Dividends, expenses, and assets all increase on the debit side and have debit ending balances. Liability, owner's equity, and revenue accounts, on the other hand, increase on the credit side and all have credit ending balances. All right, let's take a look at these transactions. January 2nd, we issued common stock for $50,000 cash. Cash increases $50,000. It's an asset. This is an investment by owners, so stockholders' equity increases $50,000 through common stock. When it comes to debits and credits, we'll debit A, cash, credit H, common stock. January 5th, borrowed $20,000 cash from the bank, signing a 5-year notes payable. Cash increases again, but this time the company owes it back in the form of a note payable, which is a liability. So we increase liabilities at this point. We'll debit cash, A, and credit notes payable, G. January 10th, paid a cash dividend of $3,000 to stockholders. Cash decreases, which is an asset, and stockholders' equity decreases through dividends. Dividends reduce stockholders' equity, but the account itself is increased with a debit. Equity accounts normally carry a credit balance, but dividends has a debit balance, which is the opposite, making it what's called a contra account. It's important to remember that while dividends reduce stockholders' equity, they are not expenses. They are a return of earnings to stockholders. So for this transaction, we'll debit J, dividends, and credit A, cash. January 15th, purchased equipment for $15,000 cash. In this case, both accounts are assets. Cash decreases while equipment increases. Total assets don't change. We just traded one asset for another asset. So for this one, we would debit D, equipment, and credit A, cash. January 18th, purchase supplies on account, $1,200. Supplies, an asset, increases. Since nothing's paid yet, accounts payable, a liability, increases as well. So for this transaction, we'll debit C, supplies, and credit E, accounts payable. On January 25th, we performed services for a client and we received $6,000 in cash payment. Cash and asset increases, and since this was earned through normal business activity, service revenue increases equity. So we'll debit A, cash, in credit K service revenue. January 27th, performed design services for a client on account, $4,000. Same kind of revenue, but this time it's billed rather than collected. So accounts receivable, which is an asset, increases instead of cash. The customer owes us. Service revenue increases equity because all revenues increase the equity account. So we'll debit B, accounts receivable, and credit K, service revenue. January 28th, paid $700 cash on account towards supplies purchased. Well, since we're paying cash out, cash, which is an asset, decreases. Since we're paying off an accounts payable, which is the liability, decreases. Nothing affects equity in this transaction. So we debit E, accounts payable, and we credit A, cash. January 30th, paid $3,500 cash for employee salaries. Well, cash, which is an asset, decreases, and salary expense decreases stockholders' equity. Anytime we incur an expense, the increase in an expense causes a decrease in stockholders' equity. So we'll debit L, salary expense, and we'll credit A, cash. January 31st, received a utility bill for $450. It'll be paid next month. So in this transaction, no cash moves, but the expense is still incurred. Utility expense, because it's an expense, will decrease stockholders' equity. And accounts payable, because we owe the bill, will increase since the bill is unpaid. So for this transaction, we have a decrease in stockholders' equity due to the increase in expense and an increase in liabilities because the bill hasn't been paid yet. We'll debit M, utility expense, and credit E, accounts payable. Also on January 31st, we collected $2,500 cash from the client billed on January 27th. Cash increases because we're receiving it, so our assets increase. Accounts receivable decreases because our customer is paying us off. Accounts receivable is an asset. So both accounts involved are assets. No new revenue here. That was already recognized on the 27th. This just converts a receivable into cash. So we will debit A, cash, and credit B, accounts receivable. The final transaction, also on January 31st, states that we received $3,000 cash in advance from a client for services to be performed next month. Because we're receiving cash increases, so our assets increase. But nothing is earned yet. That creates a liability. Deferred revenue is a liability account. It increases instead of revenue. For this transaction, we are actually getting paid in advance. So we will debit A, cash, and credit F, deferred revenue. Now that we've analyzed each transaction and their effect on the accounting equation, let's add up the columns to make sure everything balances. Assets total $77,000. Next, we look at liabilities. Liabilities total $23,950. Then we look at stockholders' equity. Stockholders' equity totals $53,050. When I add the liabilities to the stockholders' equity, I get $77,000. My accounting equation balances. My assets equal $77,000. My liabilities and stockholders' equity equal $77,000. We can also determine net income at this time. The revenue column totals $10,000. The expense column totals $3,950. If we have revenues of $10,000 minus expenses of $3,950, we have a net income of $6,050. This video has two big takeaways. One, accounting is a double entry system, with every transaction affecting at least two accounts. And two, assets always must equal liabilities plus stockholders' equity for each and all the transactions. Knowing this means you're prepared to perform journal entries, post to the general ledger, and prepare a trial balance. Thanks for watching this video. I hope it helps you understand how all transactions are handled by every company.